Headlines from the 2025 IPO market read CoreWeave, Circle, Klarna. But one of the best performances came from a defense and aerospace company most investors had never heard of. While the financial media chased every AI headline it could find, Karman Holdings quietly soared nearly 300%. And this past performance tells us something important about how the market was filtering new stock signals. Here's the issue. We spend enormous time and attention on the loudest names in the room, but the market doesn't reward noise. It rewards positioning. So the real question isn't, why did Karman trade up? The real question is, why did almost nobody see it coming? And more importantly, what does that pattern tell us about how most investors are filtering the IPO market right now? That's what we're going to work through today. Hey, welcome to New Stock Signals. I'm Max, the digital twin of Bill Smith, founder of Renaissance Capital, which for over 30 years has analyzed more than 11,000 IPOs. Bill personally researches and writes every video script himself. I hope you enjoy. He reads every comment, so be sure to share your thoughts below. Nothing in this video constitutes personalized investment advice. Always consult your own financial advisor before making investment decisions. Let's get into it. Here's the reality. We are in the early stages of the biggest IPO reset in a generation. New companies are coming public at a pace we haven't seen in years. And the market's attention is almost entirely concentrated on a handful of high-profile names. That concentration creates a problem. It also creates an opportunity. Because when attention is narrow, the overlooked names are where the real edge lives. Karman is a clear example of that dynamic. And if you want to understand how to find that edge systematically, stay with me. This is for you. Let me give you some context. Defense and aerospace, IPOs, are historically underanalyzed. Full stop. There are a few reasons for this. The customer is largely the U.S. government, which means contracts are opaque, procurement timelines are long, and the analyst community tends to focus on commercial tech because the story is easier to tell. That opacity is not a bug. For serious investors, it's a feature. Think about it like this. Every time the market fixates on what's easy to explain, the AI data center, plays, the consumer apps, the names with brand recognition, it systematically underpays attention to the harder to explain categories. We've seen this pattern before. When Palantir went public in 2020, it was underestimated for years, partly because defense and intelligence data analytics didn't fit the standard tech growth narrative. Then the AI wave arrived and the market realized it had been sitting on exactly the infrastructure enterprises needed. When the market sees hard-to-explain companies in strategically important sectors, the pattern repeats. So what does Karman actually do? Karman is a defense and aerospace components manufacturer. Specifically, they design and produce critical structural and mechanical components for missiles, rockets, and hypersonic systems. They came public in early 2025, priced at $22 per share. They didn't generate massive first-day headlines. They didn't have a consumer brand. They weren't presenting at tech conferences. What they had was a contract pipeline serving the U.S. Department of Defense and major prime contractors at a moment when U.S. defense spending, and specifically hypersonic weapons development, was becoming a national priority. Karman is embedded in that supply chain. Here's what really matters. The defense budget for hypersonics has increased significantly in recent years. The U.S. has faced well-documented urgency to close the gap with China and Russia in this category. That urgency translates directly into long-duration government contracts, the most durable revenue base any company can have. Now think about what that means from a business model standpoint. Long-term government contracts create predictable, high-visibility revenue. Switching costs are enormous. Once you are designed into a weapon system, you stay designed in. Margins are protected by the fact that cost is secondary to mission-critical reliability. Think of it like this. You don't cut corners on the components inside a missile. The defense contractor buying from Karman is not shopping on price. They are buying on certification, reliability, and supply chain continuity. That's the key insight. Karman isn't competing on cost. They are competing on qualification. And once you are qualified, the barriers are high. That's the structural characteristic worth understanding, and a fundamentally different business model than most of the IPOs that got attention in the same window. CoreWeave's story is AI infrastructure, real, important, but competitive and capital intensive. Circle's story is crypto-adjacent financial infrastructure, real but cyclical and regulatory sensitive. Karman's story is the U.S. needs to build more hypersonic weapons. We make the parts, and we are already designed in. That's a durable economic position in theory, but the market was distracted by louder names. So what does this mean for how we approach the IPO market? Let me be clear about what I am not saying. I am not saying defense companies are automatically good investments. Procurement risk is real. Program cancellations happen. Contract concentration can be dangerous. What I am saying is this: the filter most retail investors are using is broken. The default filter is what is getting covered, what is getting talked about, what is the narrative I keep hearing. That filter optimizes for noise. The better filter asks different questions. Is this company in a sector where government or enterprise demand is structurally increasing? Does this company have defensible positioning, contract lock-in, qualification barriers, or switching costs that protect margins? Is the management team experienced with long-cycle revenue and capital discipline? And uncritically, is the company being ignored because it's hard to explain, not because it's weak? If a company answers yes to every one of those questions in its prospectus, but it doesn't come attached to a compelling consumer narrative or an AI buzzword, it gets filtered out by most investors before they ever read page 1. That's the mistake I want you to stop making. Here's how I think about it. When I analyze a new IPO, I don't start with, is this exciting? I start with, is this durable? Excitement fades. Durability compounds. The practical implication is this: in the current IPO cycle, the companies generating the most media attention are not necessarily the companies with the best fundamental positioning. The attention is concentrated on a handful of AI infrastructure plays, and many of them are priced to perfection. Meanwhile, the defense and industrials category, mission-critical companies with government contract visibility, high switching costs, and strong margins, is being systematically undercovered. Defense isn't glamorous, but spaces without glamour are historically where overlooked opportunities have surfaced. One more thing. If you had applied this filter in 2025, looking for unknown new stocks in strategically important sectors with durable contract structures, Karman was findable. It was in the data, in the prospectus. Most investors just weren't looking there. The discipline to look where others aren't, that's the edge. And it's available to anyone willing to do the work. Now, let me address the obvious objections, because I have them too. Objection 1, Karman's takeoff is already priced in. The opportunity is gone. That may be true on Karman specifically. I don't know where this stock goes from here, and I wouldn't pretend to. What I know is the pattern is not priced in. There are other winners out there. The question is whether you have a system that finds it before it runs up or after. Objection 2, defense is too political, too opaque, too hard to analyze. That's a fair concern. The opacity is real. Government procurement is not transparent. Program risk exists. But here's the reality. That opacity is exactly why the market underanalyzes these companies. If it were easy to analyze, the edge would already be gone. The answer isn't to avoid opacity. The answer is to develop better tools for navigating it. Read the contracts. Track the DoD budget line items. Follow the prime contractors and their sub-supplier relationships. It's work, but it's work the market isn't doing. Objection 3, I don't have access to this kind of analysis. That's the problem we are trying to solve, here, on this channel, and through our research tools at Renaissance Capital. The institutional edge isn't intelligence. It's information and process. Both are learnable. Let me be clear about what I don't know. I don't know what Karman's stock price does in the next 6 months. I don't know if defense spending stays at current levels. I don't know if a program cancellation affects their contract pipeline. What I do know is the framework that surfaces this kind of company is consistent, and applying that framework across the next wave of IPOs is exactly the work we're doing. Here's where we land. Karman Holdings took off after its IPO. Almost nobody covered it. That's not an accident. It's a pattern. The market's attention is concentrated. The media covers what is easy to explain. Retail investors follow the coverage. And the overlooked names, the ones with durable fundamentals and no compelling consumer narrative, sit there undervalued until the market eventually catches up. The lesson isn't about Karman specifically. The lesson is to build a filter that finds the next one before it runs. That means asking different questions, looking in different places, doing work the crowd isn't doing. This isn't about chasing headlines. It's about building a system that works when the noise fades. If this kind of analysis is useful to you, subscribe, like this video. And if you want the deeper framework, the way we screen new IPOs before they get covered, check out the links below. I read every comment. So tell me, which overlooked IPO are you watching right now? The edge in this market doesn't come from watching what everyone else watches. It comes from building the discipline to look where they don't.